Aqui, acho que está
This webinar is being live streamed. Apareceu isso agora.
Tá.
Live YouTube. Now it's live, I think. Let me see.
Just let me
agora
share the presentation again.
Yeah. Now I think that because you start the live stream, then you have to reshare your presentation.
Estamos no ar.
Just a second.
So let's start now. Thank you very much, Professor Jefferson, who is Assistant Professor of Finance at the São Paulo School of Economics at the Getúlio Vargas Foundation. Thank you very much for accepting our invitation to our seminar. This seminar is hosted by the COPPEAD Finance Accounting and Sustainability Research Lab. I'm the head of the lab, and we do these monthly presentations to open COPPEAD presentations from cutting-edge research. That's a paper that will still be published, and we will enjoy your presentations about what's currently being researched, and we hope that we can serve you with some kind of comments that may be of help for your presentation, for your future paper. Now, so the paper now is going to be presented by you in 45 minutes. Then I come back for 15 minutes of discussions and comments. And if anyone who is watching here they can type their comments in Q&A. So thank you very much, Professor Jefferson. You can start your presentation.
Appreciate Professor Rodrigo for the invitation. It's a great pleasure to be back to COPPEAD, where I was a professor. It was a short passage, but a very nice one, so I feel home. And it's very good to be here to present. It's a working paper on ongoing research. It came from the master dissertation of André Gimenes, one of our master degree students in FGV. And it's a joint work also with Professor Imran Yousaf from Wenzhou-Kean University in China. So the title is Store of Value or Speculative Investment, Market Reaction to Corporate Announcements of Cryptocurrency Acquisitions. So I will start with the introduction with a question. So why do traditional companies acquire cryptocurrency? And what do I mean with traditional companies? Are those companies whose core business is unrelated to crypto or blockchain or any other distributed ledger technology. Okay, so for example, a mining company should have Bitcoins or Ethers or whatever in their balance sheet, because their core business is to mine Bitcoins, for example. So we're not interested in those companies. We are interested in traditional companies. They are retailers, they're industry, they operate in the tech industry. So why do they acquire cryptocurrency? Okay, to diversify cash. The cash there is not used to the daily operations of the firm. It's one potential reason. To maximize return on cash and cash equivalents, especially during times where the interest rate is low, or perhaps are managers betting with shareholders' money, or any other agency related explanations. Could be some behavioral one, so fear of missing out. So one company starts to acquire crypto, and so I start to buy as well. And there's something that it seems to have happening, because a lot of firms did it following Tesla's announcement in 2021 that the company bought $1.5 billion in Bitcoins. Okay, so it's not clear why a company that operates in a given business is making some kind of crypto investment that is unrelated to its core business. Okay, it's not clear, and more than that, from the shareholder value perspective, it's unclear what are the consequences, right? So if you think of a traditional investment, like buying or acquiring a new another company, or expanding the operations through CapEx investment, you can analyze it through DCF models, internal rate of return, payback, and so on. So think of applying to cryptocurrency. Okay, so if you think of the NPV formula, cryptocurrencies, they don't pay to the owner cash flows. Okay, they're not cash flow generator assets. Okay, and the discount rate is also very hard to think of. We know that they are very risky investments, so it should be a big number, but it's actually very hard to get an estimation for R in this formula. Okay, so at the end of the day, the NPV of this project could be anything. Okay, and to motivate you, in early 2021, so Tesla bought 1.5 billion of Bitcoin, and it caused the currency to spike. The market price of Bitcoin increased after the announcement of Tesla. And if you look at the 10K filing to the SEC, there are some potential reasons that the management of Tesla point out for that particular investment. So in January 2021, we updated our investment policy to provide us with more flexibility to further diversify and maximize returns on our cash. So they're exchanging US dollars for Bitcoins, for example. They're expecting to maximize returns on that cash. That is not required to maintain adequate operating liquidity. As part of the policy, we may invest a portion of such cash in certain specified alternative reserve assets. Therefore, we invested an aggregate $1.5 billion in Bitcoin under this policy. Okay, so this is a core case. Okay, there are other companies that made that movement, but Tesla, it's a big one, big player, and it brought a lot of attention to the market. So ex-ante is very hard to understand what are the market impact, the value impact of those kind of investments, right? Because you have risks and opportunities. From the downside, you can think of uncertainty on pricing. Okay, no one knows the true fundamental value of Bitcoin, for example, or Ether or any other crypto. They are high volatile assets. They are subject to regulation, okay, in different countries that might get the value to go up or down. There is the emergence of central bank digital currencies. Okay, 9 out of 10 central banks in the world are working on CBDCs. Some of them more in a pilot phase, like Brazil. Okay, so and you have the opportunities like high fast returns, institutional investments that are coming to the market consistently, long-term potential of distributed ledger technologies, the scarcity of this kind of alternative assets, and so on. Okay, so if you think of the market effects, it's hard for ex-ante to determine because it could be either positive or negative. We need to empirically address this. Okay, so this is kind of a motivation for what we're doing in this paper. Specifically, what we do in this paper, we focus on traditional firms, okay, those whose core business is orthogonal to cryptocurrencies or DLTs. Our data, we are looking to events of acquisition or investment, selling or divestment. There are a couple of firms that divested from past cryptocurrency investments, and acceptance or of cryptocurrency as means of payment. Okay, so when, for example, Burger King started to accept Bitcoin for payments, these are some kind of adoption event that we also explore. So we try to categorize events in acquisition or investment, selling and divestment, and acceptance as means of payment. The empirical design, we use the traditional event study approach, in particular the market model approach, to estimate abnormal returns, cumulative abnormal returns, and cumulative average abnormal returns around these events. We perform a lot of hypothesis tests on individual and group level analysis. We run cross-sectional regressions to understand what drives those cars, those cumulative abnormal returns. And I think the most important part of the paper is going further on the heterogeneous analysis to explore the cross-sectional variation in the degree of exposure to cryptocurrency. Okay, so you can buy 1 Bitcoin or $1 million in Bitcoin, or you can buy 1.5 billion in Bitcoin. But actually, you have to look to the size of the firm as well. Okay, so you have an objective measure to capture this cross-sectional variation in the degree of exposure that we exploit in this paper. So we find that at the aggregate level, when you look all those events, the market reaction is slightly positive, but statistically indistinguishable from zero. However, when we go further on the heterogeneity analysis, the extent to which a firm gets exposure to crypto, what we call skin in the game, shapes abnormal returns. And that seems to be a very important result, at least in our view. And further analysis revealed that such effects stem from economically meaningful balance sheet acquisitions of Bitcoin or Ether. Most of the times Bitcoin, but there is one company in our sample that bought both Bitcoin and Ether. Okay, so this is the kind of particular event that guides abnormal return, this positive market reaction around the events. So the stock market seems to distinguish between high and low corporate cryptocurrency exposure. I'm going to talk a little bit about the related literature. There are a lot of papers focusing on the adoption, behavior, and perception of crypto assets. Okay, so for retail investor, I referenced one of them, the Platanakis and Andrew Urquhart 2020, but Andrew Urquhart has a lot of papers on this issue. And so we know the characteristics and how the investors, the retail investor, perceive this kind of asset class, okay? And we also know that there are some kind of potential benefits for investors to diversify, but this kind of diversification benefits, it seems to depend on the time frame, okay? So, and it also seems to be time variant, okay? Different time periods, you got different results. There are also some literature that look at the hedge and safe haven properties of crypto assets, okay? There is a debate on that, hedge for inflation, hedge for real world risks, and so on. Okay, so for retail investors, you have a lot of papers, okay, and knowledge. For institutional investors, there is just a few papers. For example, one survey that shows that institutional investors, they don't care that crypto assets are very volatile, okay? They are okay with that. They seem to look to other attributes or other features, like the long-term potential of the blockchain technology. Okay, and when you go to corporations, so that's is the literature that we feed in. We can separate in blockchain hysteria or investor mania. So I have a very interesting paper. It's published in the Journal of Corporate Finance that show that when a company changes its name to something, its actual name plus blockchain, the market reacts positively. Okay, so this is some kind of artificial, sometimes this is just a name change that's unrelated with an actual meaningful or valuable project. Okay, so the value of the company shouldn't change, but they actually change. So this is the kind of blockchain hysteria, okay, during the hype of some years ago. Like it was in the dot-com bubble in the early 2020s. And nowadays with artificial intelligence and something like that, it should be happening something similar, okay? More importantly, we have some papers that look at the value implications of blockchain-related investment, okay? So they try to, they search for investments, firm level investments that relates to the use of blockchain technology. Okay, and they find on average that this kind of investment, when the company announces, its value increasing. Okay, but it fundamentally depends on the stage of the investment. Okay, so if that particular investment is in the very early stage, the market reaction is slightly positive on the day of the event, but the effect vanishes. Okay, on the contrary, if the project is well matured, if it's in an advanced stage, it seems to have a permanent effect on corporate value. So I think that's really interesting to think of that. But these papers are looking to general blockchain related investment. They're not looking to cryptocurrency investment. Okay, so there are some kind of uses like supply chain when you use a corporate or a non-public blockchain with your suppliers. Okay, there is some kind of event that is very common in that particular industry, but that's a bunch of other blockchain related investment. Okay, so the literature has not looked at the balance sheet acquisitions of cryptocurrency, and so that's the kind of more specifically the topic that we try to understand in our paper. Okay, what happens to corporate value, and if all events are the same, or if it depends on some kind of skin in the game. Okay, if the firms is just signaling some kind of commitment that does not actually exist with crypto, versus firms that are actually committed and are investing firmly in cryptocurrency. So we try to disentangle these two kind of events. Okay, so the data and research design, we manually search for the events. Okay, we look at regulatory filings, for example, at the SEC, the CVM equivalent at the United States. We look at the 10Ks, 8Qs, and other regulatory filings. Those kind of events, they are also very noticed in the media. Okay, so when Tesla, but not only Tesla, but Bitcoin, you can see in a lot of sites, traditional and more innovative sites. Okay, so we manually search for Bitcoin acquirances and investments and Ether and so on. Okay, so we kind of form our pool of events on these two ways, news and looking at regulatory feelings. The financials we collect from Bloomberg. We got 35 events from 2014 to 2022. Okay, we look from the January 2014 at the early stage of crypto to the end of 2022. We got events in several countries. So we look at the New York, London, Toronto, Oslo, Hong Kong, Tokyo, and São Paulo stock exchanges. And our first certification of events, we got 21 related to the acquisition or investment. Okay, it could be not only balance sheet acquisition of a given crypto, but also investment or partnership in a crypto company. Okay, we got some cases like that. So there are 21, the number of events. Selling and investment, we got 2 events. They're more rare ones. And acceptance of as means of payment, we got 12 events in our sample. Okay. So methodology is the event study approach. Okay, this is very traditional, but just in a nutshell, to estimate the abnormal returns and cumulative abnormal returns, we use the market adjusted model from McKinley. We are actually measuring the abnormal return as the difference between the actual return of a given stock at a given time period minus the expected return. Okay, and this expected return we are estimating in looking to 126 days before the beginning of the event window. Okay, we are estimating an alpha and a beta, okay, relative to the market portfolio of that particular country. Okay, so if you're looking in Brazil, we are using the Ibovespa as the proxy for RMT and so on. Okay, and then the cumulative abnormal return for security J over a given event window is then calculated as the sum of these abnormal returns. Okay, so very straightforward, very common. Just to give some details on these windows, we estimate looking to 126 days prior to the beginning of the event windows. We use 21 days before and after the event, but we actually in the paper we reduce it to -5 to +5 days around the event day. Okay, because those abnormal returns in multiple event windows, they were very correlated, and we didn't see a marginal gain in using a lot of them. Okay, so we kept the most used ones in the literature. Okay, we have a very drawback in this analysis is that we have a small sample. Okay, so when we do our hypothesis tests, we not only look at the traditional t-test, but we also look in other tests. Some of them, they are more suitable for the characteristics of our sample, specifically a small sample. Okay, so the Wilcoxon sign rank test, the generalized sign test, Corrado rank test, and so on. Okay, so we compare the statistical significance using a bunch of tests. Okay, so I'm going to the results. Of course, before looking at market reactions per se, we looked at what's happening when the company announced adoption of crypto. Okay, so we kind of see that on average, this kind of announcement occur when the Bitcoin price is trending upwards. Okay, when there is a bull market in the crypto industry, so there's more likely that the manager will announce that particular investment or acceptance as means of payment. Okay, so this is kind of what we see in finance, in corporate finance, more specifically of market timing. Okay, that managers try to time the market. Okay, they try to issue bonds when interest rates are low. They try to buy back stocks when they have devalued. Okay, and perhaps is being priced below the fundamental value. Okay, so this is some kind of evidence, we suggestive evidence that we find here. Okay, but that's not the focus of the paper. The focus of the paper is analyzing market reactions. Okay, so this table we have the several event windows. Okay, you have the average abnormal return on day 0. Day 0 is the day of the event. From day -1 to 1, -2 to 2, and so on. Okay, you have several event windows for several groups. Here we have all events in our sample, 35, and here we stratify in 3 categories: investment or acquisition, means of payment, and divestment. Okay, so overall, you have some kind of, and here is the cumulative average abnormal return for that particular group. Okay, so on average for the 35 events, the abnormal returns on these windows are slightly positive. Okay, but when we look to the p-values, okay, so here are the p-values of each of the tests in the columns. Okay, they are most of the time statistically non-significant. They're positive but statistically insignificant. Okay, there are some exceptions here, but overall the big picture is that investment and acquisition, the abnormal return seems to be a little higher, a little larger than for other kind of events. For means of payment, it seems to be slightly negative, but again, statistically equal to 0. And investment is also around 0. Okay, so there's nothing really interesting in this table, okay? But that seems to be the big picture on the aggregate level, okay? So when you think of what drives those cumulative abnormal returns, okay, what makes one particular firm in our sample to have an abnormal return larger or perhaps very negative, okay? We could think of market level variables, firm level variables. So market level could be like the past returns of Bitcoin, for example, how is performing the crypto market. Firm level, we could think of cash, we could think of investment opportunities, we can think of size of the firm and so on. We also could think of industry level characteristics, such tech firms seems to be those that benefit the most from blockchain investment. Earlier research has shown that, and so we kind of test that in our setting as well. And it could be also some kind of country level differences, okay? We are working with several countries, so we could think of several forces or drivers that could shape the cumulative abnormal returns, okay? We would like to estimate like a big equation, a big equation for the cars, but we have a problem that we have a small sample size, okay? So ideally, we would think of a cross-sectional regression explaining the cumulative abnormal return of firm I equals an intercept plus beta 1 times a tech dummy, the dummy for tech firms, plus the beta 2 times a market level feature like BTC past returns in the preceding weeks, plus a vector of firm level variables such as cash, size, and so on, plus country fixed effect characteristics, plus on their return. Okay, unfortunately, since we have only 35 events, we have two big problems here, right? The first one is that the statistically significance of the coefficients tends to be small because of critical t-values, okay, on a sample size of 35. And if you estimate several parameters, you lose degrees of freedom, so you end up with the critical t-values very large. Okay, so it's very hard to reject the new hypothesis that that particular coefficient equals to 0. And furthermore, we have a low precision on the estimates, okay? So we have large standard errors because our sample is small. And so that's something that we are working on that. In this presentation, in this actual working paper, the one that I'm showing here, the result, it does not consider this general to specific approach from David Hendricks. This is the one we are implementing to deal with this kind of issues. But the version that is here in these particular slides are the old ones. We kind of qualitatively assess and try to think of a general to specific approach, but it's not a mechanical one, okay? It's not an algorithm determined like the one we intend to implement, okay? So we have more parameters that we like to have in the next version of this working paper. But here we have tech firms dummy, financial firms dummy, one dummy for the type of event, okay, investments, and some market level and firm level characteristics, okay? Because of those issues that I told you before, and we looked to the abnormal returns, and we saw that they were very close to 0. When we do this analysis, it doesn't seem that some specific feature of the firm or the market shapes the abnormal returns, okay? So we have as dependent variables the cumulative abnormal returns around this window, okay? And we have in panel A all events, in panel B we're excluding the investment events, okay? So we were ending up with 33 observations. So this is you have to take carefully this kind of results because the sample size is small. But overall, what we find is that tech firms seems to have a larger cumulative abnormal returns than other firms, okay? This is the future. There perhaps some kind of synergy between tech firms and crypto investments that market sees as a good feature, okay? But overall, it doesn't seem to have a very nice fit. So on the aggregate level, there's nothing very interesting about it. The problem, besides this sample size problem is that at the aggregate level, you are treating small and substantial corporate cryptocurrency investments equally. Okay, so you're neglecting the degree of exposure to cryptocurrency. So it may hide the genuine underlying market reaction. And if we look in our sample, there is a significant variability in the size of cryptocurrency acquisitions. Okay, so when you take the market value in US dollars of a particular acquisition and you divide by the total assets of the firm also in US dollars, you get a ratio that varies from 0% in the case of Globant SA that acquired $1 million in BTC relative to a 1.2 billion in total assets, and a maximum of 27.3 in the case of MicroStrategy that acquired 250 million in Bitcoins relative to 917 million total assets. Okay, so you have this kind of variability. And so in this heterogeneity analysis, what we do here is to separate firms, okay, and events more specifically into high, medium, and low degree of cryptocurrency exposure. So we got this ratio between the crypto acquisition in US dollars and total assets in US dollars. And so the top tercile of this ratio, we are assigning as high degree of cryptocurrency exposure, and the low tercile as low degree of cryptocurrency exposure. Okay, so this is a market-based one, an objective measure, okay? But the problem is that we do not have, for the other events, we do not have an objective market-based measure to classify firms into high, lower, medium exposure, okay? So that's the big problem, and then we have to rely on some kind of systematic qualitative assessment, okay? We try to do that, and I will explain in a minute, okay? For the remaining events, we apply a systematic sorting strategy that resembles the classification of corporate blockchain investment proposed by Autori, Clark, and Young 2021. It's that paper that I told you that separates blockchain investment into early stage and late stage, or those that are material versus immaterial investment. Okay, we try to follow the same idea here. And more specifically, the qualitative assessment, we assign as high exposure the effective direct acceptance of cryptocurrency as means of payment by industry pioneers. So when you have a firm, okay, a company that it's announcing that it starts to, now it accepts Bitcoin as means of payment, if the company is the pioneer in its industry, so we consider that a high exposure event. It happened in the telecom services with AT&T, in banks with the JP Morgan Chase, software infrastructure with Microsoft, internet retail with Overstock.com, and credit services with Visa. Okay, so these are the kind of events that we classify as high exposure because they are effective and they are by industry pioneers. Okay, and also we have some kind of M&A or partnerships such as BlackRock and Mercado Libre. They are worldwide noticed and economically relevant. Okay, so as the partnership between BlackRock and Coinbase is classified as high exposure. Conversely, low exposure status we assign for events where the firm just plans to accept cryptocurrency. Okay, so there are some examples of AMC theaters that the news is just that the company plans or intends to accept cryptocurrency. It's not effective acceptance. Okay. Also, there are some global companies that started accepting cryptocurrency only in a single country or store. So one particular store or chain of stores will be BMW or Xiaomi, but only in Portugal is accepting crypto. So those kind of limited crypto acceptance we classify as low exposure. And finally, only indirect or partial acceptance of cryptos as means of payment, such as gift cards. What happened to Starbucks in our sample? It started to accept crypto, but only through gift cards. So that's not actually acceptance of crypto, okay? And medium exposure would be fundamentally effective acceptance by a non-industry pioneer, okay? So for example, I have some examples here, okay? So this is kind of, we try to have a systematic judgment to assign if it is non-market-based events, okay? So for example, if you look here at the low exposure, meme stock AMC now plans to accept Bitcoin. This is the headline, okay? It's not actual acceptance. So this kind of signaling to the market is very, it's not a commitment to the firm. It's just the company plans to accept. Starbucks now accepts Bitcoin as a payment, kind of. This is the gift card story that I told you before. So these are two examples of low exposure. On the other extreme, we have high exposure. So one example is Overstock.com becomes first major retailer to accept Bitcoin. Okay, this was an event, our first event, I guess, in 2014. So Overstock is the leader, is the industry pioneer at the online retail industry. Okay, same things occur with Burger King. Okay, when it started accepting Bitcoin payments, and we have other firms in that particular industry that followed those leaders. For example, Rakuten started to accept Bitcoin. It's also in the online retail business, but it occurred after Overstock. So we classify it as a medium because it's effective, but it's not an industry pioneer. Same things with Chipotle. Okay, Chipotle announced in 2022, this is a recent event that now accepts cryptocurrency as payment. So it occurred after Burger King, okay? So it's in the same industry, not an industry pioneer, more like an industry follower, so we classify as me. Okay, I don't know if it sounds reasonable, but we try to do this effort to classify in the better way, knowing that this is a subjective classification. Okay, so we have two groups of events. The first one is those events where we have a market metric, okay? So how much the company acquired of crypto in US dollars and the total assets of the firm. So this is our objective determinant. And the other one, we have to rely on this qualitative assessment, okay? So with this low, medium, and high degrees of cryptocurrency exposure, which are dummy variables, we rerun the empirical analysis, okay? So now things start to get more interesting, okay? So when you look to the high exposure group, so these are the events that are classified as high skin in the game. You can see on average, the market reacts positively from 3.6 percentage points to something like 8 in this particular window, okay? So these are kind of meaningful market reactions among these different event windows. And when you look at very different tests, including the t-test, okay, we can see that those response is statistically different from zero, okay? It's positive and statistically significant in most cases. Conversely, when we look to the low exposure group of events, what we see is that the average response is negative, okay, ranging from 1.6 to 5.1, and sometimes it's statistically different from zero, okay? But you can see that there is this kind of very critical difference between high and low exposure, okay? For high exposure events, market reacts positively and most of the times statistically significant. When you look to the low exposure group, it's negative and sometimes statistically different from zero, okay? And the medium exposure is in between these two groups. What we do here is to run the cross-sectional regression with the same as before, okay? But now we are focusing on this particular dummy, okay? So first we include the high exposure dummy, and we can see that it's always positive and sometimes statistically significant. Again, we have a small sample size. The number of degrees of freedom goes down. So it's hard to have something significant, but it seems that at least in the day of the event, it's very significant. Okay. And low exposure dummy, we find negative and most of the time statistically significant results. Okay, so when we incorporate this kind of high and low exposure dummies, they seem to explain the variability in the cumulative abnormal returns. Okay. So this is our overall results. What I'm going to do now is to show some robustness checks. Okay, the first one, it tries to deal with the fact that most events, 22 out of 35, do not have an objective measure of corporate skin in the game. Okay, so it's obviously subjective. Okay, we try to systematically approach, but it's a subjective definition. And so the specific issue, does a subjective criterion drive the findings? So to deal with such a concern, we constrain our analysis on the subsample of events where we have an objective market-based metric of skin in the game. Okay, so we're looking to the first set of events, those that there is a market-based. Okay, we're not subjectively assigning anything. And first, before looking at this exercise, when we plot several scatter plots, we have here in the x-axis the ratio between USD crypto acquisition and total assets and the market returns in different time windows, you can see a positive relationship. Okay, so the larger the size of the cryptocurrency acquisition in the balance sheet, the larger tends to be the market reaction. Okay. And that's actually what we see in this robustness check. When you look only on the objective set of events, we actually find that the market reaction is a lot larger. Okay, so if you compare all events with the only balance sheet subset of events, even though it's a small sample size, but we can see that the market reactions, both for negative and for low exposure and for high exposure events, they more than double the effect. Okay, so instead of -4, we now find -10. Okay, as market reaction for those kind of balance sheet events where the company is just buying a small fraction of Bitcoin. So the market is reacting negatively, and when the firm has a lot of skin in the game, the market reaction is a lot positive, something between 10 and 23 percentage points. So they are very large and a lot larger than when you looked at all events. So it seems that actually it's the objective measured events that are driving the overall results and not the other way around. We also try to deal with the influence of outliers, using median linear regression instead of OLS to estimate the parameters and excluding the extreme cars. Okay, so we take the extreme cars in both tails and exclude them from the analysis, and you can see that actually the results doesn't change. Okay, so they are kind of positive for high exposure, negative for low exposure. Sometimes it's statistically significant. So it's not the influence of a particular outlier that is driving our results. Okay, and finally, my time, I think I have 4 minutes. Okay, so I'm gonna be in my time. Finally, we check whether our results are biased because of subjective assessment of high and low skin in the game status. Okay, so specifically what we do here is to break down the high exposure dummy and the low exposure dummy into their components. Okay, so you can disentangle the role of each underlying sorting factor of the heterogeneity analysis. I'm going to explain here better. We are running the same cross-sectional regressions, okay, with the cars in different time windows as Y variable. What we do here, so in the first panel, we are looking to the high exposure to cryptocurrency dummy, so high skin in the game. We're breaking that dummy into its 3 parts. The first one, top tercile acquisitions, Bitcoin or Ether. Okay, this is the objective measure we talked before. Second feature, industry pioneering and accepting crypto for payments. Okay, and worldwide noticed M&As or partnerships. Okay, so what you can see here that except from the day 0 where this worldwide noticed M&As or partnerships, they are also driving positive results, positive abnormal market reactions. But actually, the feature, the component of the high exposure dummy that explains that are systematically related to larger cars is being the top tercile of acquisitions. Okay, so just particularly large acquisitions of crypto, they share a very large abnormal return, something like from 10 to 22 percentage points larger than comparing firms. Okay, and the same thing here in panel B for low exposure to cryptocurrency. We break into the bottom tercile of acquisitions, only partial acceptance for payments, and just plans to accept cryptocurrency for payments. And what we see here is that the result, what explains the result, it's being in the bottom tercile of acquisition. Okay, so this is negatively and statistically significant to explain the cars. Okay, so all these variables, all these regressions, we have control variables. Okay, we're just showing the coefficients of interest. Okay, but we are controlling for other firm level and market level factors. Okay, so in this sample, a small sample of 35, which is a clear limitation, we have to look at our results and interpret them carefully, okay, because of this small sample issue, okay? But we find that at the aggregate level, the cumulative abnormal returns are statistically equal to 0, so there's nothing really fancy or interesting about it. But when we break these events into high and low skin of the game, we kind of understand that the market reacts differently. Okay, so there are some kind of non-rival explanations. So perhaps market sees direct cryptocurrency acquisition as value increase. Okay, as long as the skin in the game is high enough. And another possibility is that those events increase the salience of that particular stock. So that could be some kind of attention channel. So everybody looks now to Tesla, okay? So they start to buy more, and that's why the stock market reacts positively, okay? Our findings are very important because corporate managers, they don't understand. I think our research is the first one to address the market reaction to direct acquisition of crypto, okay? So investors and analysts may also benefit from our research. So we contribute to this growing literature that examines the corporate implications of blockchain-related projects or investments, okay? There's a growing literature on that. And it's essential, though, to highlight the several limitations, okay? Not only a reduced number of events, which is the more salient one, but also announcements are sometimes clustered in time and markets. And so there is a room for further studies to explore better this kind of research question, particularly because now that digital assets and crypto assets in particular are trending upwards again, we may see another wave of firms acquiring crypto as a strategy to manage excess cash, okay, and also more crypto-related investments. So in the future, we may have larger sample sizes to look at this research question. But overall, this is what I had to say. So I look forward to receiving comments because this is a working paper. We are looking forward for comments. So thank you very much.
Thank you for your presentation. Now, show my slides. Do hear some comments, and I hope that they are comments that can help your research. Now, talking about the paper, making some introductions. A very interesting paper. That's a very relevant, novel topic about why these companies they make investments in cryptocurrency, and that's the empirical estimation is very straightforward. Okay, because you have this event, and then you see the impact of the event, and then you do that several times. But that is very easy to understand if the effects and the practical implications they're clear. And there is some nice tension theory and results because you can have a different explanation, different reasons of why companies do it. And then you can have different this kind of different motivation, different implementations affected these kind of results, and therefore this heterogeneity is very interesting, and I think it's a good point of the paper. Now, my comments. The first comment is when you compare the company tends to announce that rallies of Bitcoin. But that's a question. Is Bitcoin 5 days the best proxy? Because you can imagine that, for example, the price of the Bitcoin, can you see here the drawing, went up, but then in the week there is a small drop. And then what to say that, oh, because there is a small drop here, it announced the downturn. Maybe a longer window, because these decisions take a lot of time to be implemented. Therefore, I think that in 5 days, if the Fed is going up or down, it's not a good proxy to see if there is a market timing. I think that the last 3 months of the Bitcoin or 6 months, then it provides a better look, a better understanding of the market timing argument there. And maybe you can even show different percentage, like it went up in 10% in the previous month, 20% in the previous 6 months, for example. They used to shorter time window, but not 5 days, I think, because that's very noisy. Okay, because the market can be going up, but then can be a little bit down during some period because of a market correction, something like that. And therefore, it may help your results kind of zoom out. Okay. And another thing is that complementing this is the fear grid index. Okay, it's very spiky. You have to smooth it out. Okay, there is online for you to see it. And the problem is that's from 2018 now, so these older announcements and acquisitions, etc. You don't have the fear grid index. But I think that's another proxy of market sentiment for Bitcoin at around the time that it was announced. Because the fear grid index is just market sentiment. Okay? They incorporate surveys and other things there to kind of see the effect, if the market is more greedy or it's more fearful, and to see if this difference in the fear grid index affected the market reaction. But this is a market proxy. Okay, so you are seeing if the market perception of Bitcoin at that specific time influence the market perception of that company investing or accepting payments in Bitcoin. I think that this can be a very interesting variable to kind of be added and make a comparison. Another point that I make here is that tech firms, you find more effect there. But is that because they are tech firms and because of that they are more, okay, it makes sense to be more avant-garde in technological process, or because this company is very high price to book ratios, and because of that they are more volatile? So if you look at the past year and a half, the price of the tech has been going down, and if you look, it's very volatile, the tech stocks index compared to S&P 500, etc. It's much more volatile types of companies, and therefore it's just because they're volatile. It's not because they are tech industries, but because they're volatile companies. And then we can capture that if high price to book ratios, these companies tend to be more volatile, to kind of differentiate if you find this effect because the company is more volatile, because that's more sensitive to kind of these announcements, or because something that's industry related. Yeah, that's really because of they are really tech companies, and it makes sense for a tech company to be avant-garde, not like a retailer to accept that. It's very fringe, okay, not very much related to their operations. Okay, the high and low exposure, I think that's the meat of your results, but the problem is that it's very ad hoc, and not only that, it's surprisingly even. So it may, a person looking at it, especially a reviewer, may think, okay, it's even because it was designed to be even. So it was reversely engineered. And I know that's not the case, but I don't know if you can kind of see if you can do something that's kind of ask some kind of students to kind of separate the events. Do you think that is a major event, a medium event, or a minor event? And you ask like 10 people. And then you take the averages and you do that as a different thing. Because then you have something that's kind of not you. Because you have skin in the game there. So you know more or less what drives the results. And then you have this kind of incentives to do it. But if you do like this kind of especially if you can do with experts, like some people that are related to be quite okay, can you just rank this for me, like ask a favor for, does not need to be a lot of people, like 5 people, and then you do it and say, no, it was ranked by 5 experts in the area of PC, and then cases where it was not clear, we discussed and we find a consensus classification. That's much more robust, and I think it's much easier for the reviewer to see that, not think that it is just an add-on. Okay, and then here I say to use a contrast term. So you do 2 estimations. Okay, you do one estimation with 0, 1. Okay, and do another estimation with 0, 1. But instead of doing this, and this is not very practical, I think you can do 1. Okay, for the high exposure, 0 for the medium exposure, and -1 for the low exposure. And now the coefficient, the beta, will be the average difference from the medium to the high, and if you reverse, put it negative, from the medium to the low. So there you have an extra assumption that it's kind of symmetric. But I don't see that it would be a problem for you there. And because of that, you have more power. Okay, because you're comprising everything in just one comparison, not comparing one to everything. You are comparing the median, okay, the 1 to the median and the -1 to the median, you are average the results. So it would be like the average treatment effect, okay, from receiving or the treatment of being high exposure, low exposure, and the average treatment effect. And I think that using this contrast term is better, at least statistically, it's more concise. Now I think about what about subsequent events? Because I know for MicroStrategy that it acquired some Bitcoins, then acquired again, and then again, and it makes lots of acquisitions. It's just the first one that you use?
Yes, actually, yeah, because MicroStrategy is acquiring all the time. So we almost included a second one, but when you look at the estimation window, we had some overlapping, and we didn't want that. So it ended up being only the first one, which we thought as being the more informative one.
But then the percentage of the total assets is everything or just the first one?
No, it's the first one. It's the first one.
Okay.
It's comparing the first acquisition. I think it's 200.
The first acquisition was 33% of the cash.
Yeah, of the
total
cash.
assets.
So if of total assets, yeah. So if you look considering the follow-up acquirances, it would be a lot higher. So the company started to become like almost a Bitcoin company.
Exactly. People are saying that the problem with that stock, it's almost a Bitcoin ETF nowadays. MicroStrategy, and I don't know if so how it could incorporate it. Maybe not. Do you have subsequent events for a lot of them, for just a few of them, like not the news, another acquisition?
It's just a few of them. We have 2 in the paper. I think that Mercado Libre is one firm that at one time it acquired another business, a crypto-related business, and then it also acquired as balance sheet strategy. I'm not sure, but I think it's Mercado Libre. And there is also and Tesla, because Tesla also bought twice, if I'm not.
And then sold.
Yeah, and they sold. Yeah, a fraction of what they bought. So we consider the first one, since the second one when we would estimate expected returns, it would overlap with the first acquisition. So we just consider the first event. But we added the first time, and I think it's the only time that Tesla announced that it sold a fraction of their Bitcoins. Okay, so we consider two events. One is an acquire or investment event, and another one is a divestment event.
So now about that, can you think that you can kind of diminish the estimation window and then do a robustness test with just the subsequent events that the company that bought again, and see if that can be a robustness? Because I did a paper on contingent convertible bonds, and I did for a second announcement, and then the results kind of flipped because people like are playing the same thing again. So the results flipped. Don't know if that could happen here. But like when the company announces that I'll buy again, okay, comparing like the same companies, okay, that announces first and then announces again, doing the same thing. Can be another announcement from the company again, say, oh, we're planning again to accept. But that market may react the first time, but not the second time. Then I think that it may be something that is interesting.
Yeah, it could be. I don't think we have a large sample on that. I can remember of MicroStrategy, obviously, Tesla, Mercado Libre, that perhaps some other events. We had to take a look on that, but yeah, it could be an interesting further analysis. Yes.
Okay. And then the final one is selection bias. The problem is that these are companies that decided to invest in Bitcoin. So this is already it's not generalizable for the full market. Okay, it's not about, okay, what will happen if this company invests in Bitcoin, what the market will expect. Because even for the company that's skin in the game, this company that have skin in the game, those are large companies. There are some selection bias there. And that leads me to the final comment. So when I read your paper, like store of value speculative investment, this is about why this company invests. Okay, the reason. But then you cannot have the reason. You have the market perception, and then you may some inference about the reasoning of the company, but this is very tenuous because you do not like compare why this company decided to do it. So in a sense, it's not about store of value or investment. In this sense, it's just because the market can react positive to both. So kind of, okay, this company is storing, it's having a better kind of looking for better returns for its cash. Therefore, I'm looking for future better cash flows. Therefore, it's good. Or it is a very risky investment, but the expected value may be positive, and then I'm expecting a future positive cash flow. So both are future positive cash flows. Okay, one is riskier than one sense is riskier than another, but both have the same effect on the expected cash flows. And therefore, both theoretically drive the price of the stock up. Therefore, you cannot really differentiate. Here, what you're looking is about, and I think that what your paper is looking is not about store of value speculative investment. It's about skin in the game or just marketing prop. Okay, so I think this is what the paper differentiates, not the reasoning of the operational reasoning of the company, but rather what the company is telling them, what the market is perceiving it. It's skin in the game, or it's just a market prop. Just doing that to kind of look in the media, just no fairy dust.
Yeah, so it could be because it had 2 or 3 comments of yours. Like the first one, BTC 5 days, it's an heritage from the dissertation of André. So he took that decision back then, and we are actually projecting them. But we could definitely think of it and try to
I think that you
get a
put
better
like
estimate.
the skin in the game. I think that you put
In
that
the
in the
title.
title.
I was thinking
very
of that.
catchy title.
Yeah. I was thinking of that because that's the exact title from the dissertation. But then we went further on this kind of heterogeneity analysis. We end up doing more and more and more. And then the paper now, I think it's okay. You have to explore and sell that.
Yeah, because
differences.
if you
I
want
agree
to
with
explore
you.
that, you maybe what you want to do is to kind of get companies that are similar to them, but did not acquire Bitcoin. Okay, like this company did that, but that company did not. The same, like do kind of exact matching, like company in the same industry, similar value, total value, similar cash flow, and so on and so forth. You choose the variables to match there, and you look why did this company decide to invest in Bitcoin? Because then it's a different company. This is still illicit to me. Okay, I'm trying to see you have issue Bitcoin, not issue Bitcoin, and now I'm looking at the determinants to that. That's what the title, at least in my mind, elicits. Okay, but this is not what you're doing. What you're doing is looking at the market effect. And therefore, okay, and that may be a different paper, okay? I think that's why companies, why firms choose to invest in Bitcoin. So looking, okay, the company that invests in Bitcoin, those are companies with higher liquidities and therefore can afford to invest in Bitcoin. Those are companies that are more volatile, and therefore is the fact that a company is having like a bad year, a bad quarter, determine kind of an indicator that the company will try to do this kind of publicity stunt in the future to invest in Bitcoin. That's what I was thinking when I read the title. Okay, if the company is investing that because of cash reasons, or because of a balance, because of balance sheet reasons, or because of income statement reasons. Okay.
Yeah,
so
and I think that's interesting. A very good the other paper. But my guess, and looking at those firms, is that the similarity between them is that the CEO or the top manager is kind of someone that sees Bitcoin, has already invested in Bitcoin, him or herself. In all cases, I think it's himself, but I think they kind of share individual beliefs on this particular asset class.
And that's very interesting. You can separate, kind of get that's probably another gonna have a student to do it, because it's gonna have a lot of work. Kind of get the CEOs that have made remarks about Bitcoin, okay, and then see if that influences future investments of Bitcoin, and then control for a bunch of stuff. That I don't know if it has been done, but I think that's very interesting. And on the paper. So those are my comments. Thank you. Do you have anything to add here?
Yeah, just go back one. You bring very interesting comments. Some of them we have already thought of, and we're thinking of the improvements, and that's good to hear that you think just like us. But there are some of them that we haven't thought of them. So the fear grid index, it could be interesting to look at those 5 days. I agree with you. It would be a better metric there. The tech firms effect, we try to control for price to book. So we kind of deal with that. But unfortunately, we have a small sample size. We could try to do some interactions between tech firms and
the problem is that
and then we don't have.
Every variable that you add, the lower you get less degrees of freedom. So you have to be very parsimonious there.
Yeah, that's the big problem, because we have a small number of events, and then constraints our analysis in several ways. One of them is that particular point. Subsequent events we have talked about. Selection bias, yes, definitely. I haven't seen a paper looking at the propensity, the likelihood of a given firm relative to its peers in the same industry of similar size to acquire BTC or ETH. So that I haven't seen, but that could be also an interesting paper as well. So they are great comments, and I appreciate you, Rodrigo, for inviting me and for your comments. They certainly help us. It's the first time we are presenting this paper. We'll be in the Cryptocurrency Research Conference this year to present, hopefully in the Brazilian Finance Meeting as well.
Did you submit this paper to everything?
Yes. Yes.
Oh, so we're gonna see each other. I'll submit some paper there for everything. So looking forward to see your presentation again and everything.
So thank you very much, Rodrigo. And it was very nice to be in COPPEAD because, again, I consider myself a part of the institution. I have great friends at COPPEAD, and it's a great pleasure to be here. And thank you very much.
So I thank you very much to allow to share your paper here. And I don't think that you have any questions here, so I looked. So thank you very much. Thank you for your presentation to our lab. This is a very recent initiative here that we started. This is the seventh presentation here at COPPEAD of this finance seminar. And then next month, it's always the last Tuesday of the month, we're going to have Bernardo Rica from INSPE presenting his paper. And then in June, we're going to have Yousaf Trevisan from the PIMS, the economics graduate program there at the Federal University of Pernambuco, presenting his paper. And I hope that I can see you here again next month. And probably the one that will be hosting here will be Professor Flávio Moraes, and he invited Bernardo, and I talked to him. So he will be the first COPPEAD Finance seminar that I'll not be hosting, and asking him to host, and then we're gonna rotate amongst me, Flávio, and Klaus, that our professor of finance here at COPPEAD. So thank you very much again, and I see you all again next month. Thank you.